Why is it a global shock? Because the whole world economy will be weakened if we get into this full-blown trade war.
On Wealth Track, the lasting effects of the Trump tariffs turmoil.
Funding provided by ClearBridge Investments, the Fairholme Foundation, First Eagle Investments, Bill Miller, Baird, Strategas Asset Management, Research Affiliates, Royce Investment Partners, Seafarer Capital Partners, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. One of our favorite guests over the years was the late, great financial historian Peter Bernstein, author of the classic Against the Gods, The Remarkable Story of Risk. If Peter were here today, he would remind us to never forget that the future is unknowable. And he used to repeat it for emphasis. The future is unknowable. Regardless of the ultimate shape and outcome of the Trump tariff policies, one thing is certain. They have caused turmoil and uncertainty in businesses, governments, markets, and economies around the world. While the future is unknowable, the past is not, and there are lessons to be learned from history that apply to the current moment. This week's guest has long been a student of the economy and markets, and in recent years has published books about it. He is Nicholas Sargent, author of Global Shocks, an investment guide for turbulent markets, published in 2016, which he is in the process of updating for a second edition. He is also the author of Investing in the Trump Era, How Economic Policies Impact Financial Markets. Now, in addition, he is a regular columnist for Forbes and The Hill. Sargent is also a Stanford-educated PhD economist who, until his retirement, has spent most of his career at major investment firms in roles including international economist, global investment strategist, and chief investment officer. With events changing daily, we are taping this on April 11th, I asked Sargent to put Trump's tariff actions in perspective. Why do they qualify as a global shock?
The reason is when Trump announced these so-called reciprocal tariffs that affected every country, what it in effect did was to throw out the international trading system that had been throughout the post-war period. And that was based on this principle of most favored nation. In other words, anybody who's a member of the club gets the same tariff. Now, we've moved to a different world where with reciprocal tariffs, the United States is saying we want to make bilateral deals with all our trading partners, and we can have different tariffs for different partners. So this has major ramifications for the globe because it affects the whole international trading system.
And what is it akin to? What are some of the other global shocks that you covered in your book? And does this resemble one more than any others?
Yes. Consuelo, it's hard to believe, but about 55 years ago, I began my career at the U.S. Treasury in the Office of International Affairs under a man named Paul Volcker. When I came to work, the U.S. under President Nixon had announced that we were no longer setting an official price for gold relative to the dollar. And what this did is it ended the system of fixed exchange rates that had prevailed since 1944.
Since the Bretton Woods Agreement, right?
That's correct. Okay. And at that time, we honestly didn't know what the ramifications would be. At first, it seemed there was a dollar devaluation, and then about 15 months later, there was another dollar devaluation. But then the central bankers threw up their hands and said, we can't manage exchange rates anymore. They're free to float. And this was a seismic development because we left a world where you kind of knew where exchange rates would be to a world of extraordinary volatility. And Consuelo, it led to very high inflation, a chronic weak dollar, and we went through 2 decades of roller coaster ride in financial markets. So that, to me, was the most significant global shock, and that's how I began my book. What I'm saying today is it's too early to tell But I'm saying, when you now say we're tossing out the former trading system and we don't have anything concrete to replace it with, that creates tremendous anxiety and uncertainty. And already we're seeing ripple effects in global stock markets, world bond markets, and in currency markets. So that's why I liken this to the second leg of the post-war international economic order that's now crumbling.
And when you say system, that we're not replacing it with a system, but President Trump seems to be replacing our trade policies with unilateral agreements, with different countries. So it's not a system. What is so unsettling about that?
The way I would characterize it, Consuelo, is President Trump before had been on reality TV. I would say the closest we're coming to a TV program is, let's make a deal. So, and we're going to make a deal with all of these countries separately. At first he said, well, we're going to have reciprocal tariffs, meaning that we will put a tariff on another country that's exactly the same as the tariff they put on us. And certainly that seems fair. In fact, it's impossible to administer, because think of how many countries we trade with, say 200. Think of how many products we have subject to tariffs, roughly 1,300. You can't administer that. So what they wound up doing was coming up with a very crude, simple formula to compute the tariff rate. It said, any country, we're going to take your trade surplus with the U.S., we're going to divide it by how much you export to the U.S., and then to be nice to you, we'll cut that in half. That's how they calculated the tariff rates. So just to conclude, in the end, it had nothing to do with the tariffs. It had to do with the fact that Trump thinks bilateral trade deficits of the U.S. means the other guy's cheating us, which is not correct.
You're a PhD economist. And so in layman's language, basically, what's wrong with that equation? What's wrong with just looking at the trade surplus and saying there's something wrong with this?
When you go and study economics, the very beginning, the first thing you learn about is trade. And basically, the example was always Adam Smith. We're going back to the 18th century. Why does England export textiles to Portugal? Portugal ships back wine to England. Well, it's because we each produce things better than the other. It makes sense. This way we both benefit from the trade. If we didn't, we would never trade. But what he's trying to do is to say trade with all countries must be equal. What I'm saying is, if we literally did that, Consuelo, we would be going back to a barter economy, very primitive, that, okay, if I get something from you, you give something from me, and it must be the same. It's just impractical. It's not an efficient way of doing things. And that's why some countries may have surpluses with us, some countries may have deficits with us, but you don't want to force everybody to have no imbalances.
And I'm thinking of the example, which I hear all the time, is bananas. And actually avocados from Mexico. We don't grow a lot of avocados. We don't grow bananas. We don't grow the kind of asparagus that you can get from Mexico. They will have a trade surplus with us, and because we're buying more things that we want from them than they want from us. It's not like they're punishing us. It's just the way it is. However, there are legitimate gripes about the U.S. situation in the world, in that, we are the world's superpower. Our dollar is the world's reserve currency. Most everything is traded in dollars. And there has been what is called a hollowing out of industrial America that has happened over the last, let's say, 30 or 40 years. and much of the manufacturing has gone to countries like China, which have much cheaper labor. Is there a way to rectify that imbalance so that we in the U.S., our workers, get more jobs in manufacturing, for instance, so that we're more self-sufficient, and that the manufacturers and the factories can produce the middle-class wealth that they used to produce that they no longer do?
When we first saw the beginning of the hollowing out of American manufacturing, it was really in the Reagan years, so the mid-1980s. Why did it happen? Well, because at that time, to fight inflation, we had very high interest rates. And the Japanese would sell us their automobiles, and though then they would have a surplus. So what did they do with that money? They go and buy U.S. treasuries. On one hand, then, again, that was good for us because it kept our interest rates lower than they otherwise would be. However, U.S. companies began to outsource the production to the overseas markets. But I would say it wasn't really out of kilter. I think that really the basis for what the resentment to free trade and the like is, it was really the Chinese becoming members of the World Trade Organization around 2000. And that's when you started to see they ran huge trade surpluses with the U.S. And at the same time then, we started to see, as they were flooding our market with their goods produced with cheaper labor, how could America workers compete? So that was the beginning, really, I'd say, of the major losses in jobs in manufacturing. So my response is then, in Trump's first term, he put some tariffs on. He focused more on China for that reason. And, it turned out that there was a little bit of volatility, but in the end, we reached an agreement with China that they said, okay, we're going to buy $200 billion more goods from you. Guess what?
That's what China said.
That's what China said. They did not.
Right.
So what I believe the reason that Trump is taking a much more aggressive posture now is he says, okay, I can't let them get away with that. What were they doing? They were shipping their goods to the United States from Vietnam and Mexico because they weren't subject to the tariffs on the Chinese. So part of his motive, I believe, the reason I think that he went and said, well, if they're going to do that, I'm just going to put tariffs on everybody, 10%, so they can't get around this. I think that the mistake that was made, though, was he really went after our allies. Canada has never been a problem. And then we go to the European Union. So my point is, were there legitimate grounds for grievances, especially with China? Yes. But the way we went about doing it was to go after everybody, and in many cases on flimsy arguments. And now we have this mess.
The other very disruptive aspect of this, what's going on in the markets as well, is the fact that U.S. Treasury securities have always been considered the safe haven asset. They're called risk-free because they are guaranteed by the full faith and credit of the United States government. So you're going to be paid back. And it's a very big liquid market, and it's in the reserve currency. So it's always been considered a safe asset. The markets are questioning that, and treasuries have been selling off. I mean, they've basically, they've been declining in price, and their yields have gone up. Investors are demanding a higher yield in order to own a long-term treasury, for instance. What is your assessment or analysis of that development?
Consuelo, I come back to your first question to me. How does what we're seeing compare with other global shocks? So the shock I would like to discuss with you is what happened in 1987. And basically what was happening in the mid-1980s is we had a super strong dollar, But then we were seeing that it was too strong. Our trade imbalance was growing. Workers were losing their jobs to overseas, and the economy was slowing. So we negotiated a multilateral arrangement with other key trading partners to guide the dollar lower, okay, but we didn't want it to be a crisis situation. So we wanted the Fed to be able to lower interest rates and the dollar to weaken. And that's okay. I call that a benign decline of the dollar. And we got that.
It was orderly.
It was orderly.
It was orderly, and it was planned.
That's right. And then in 1987, early on, February, Japan, that was always buying our bonds, suddenly stopped. Why? The dollar had depreciated 50% against the yen in that period. And they finally woke up. I was talking to them and saying, if you're going to buy treasuries, you better hedge your exchange rate risk. And they hadn't done it. So they panicked and they weren't going to buy. So we came up with another agreement. They called it the Louvre Accord. And now the agreement was, we're going to stabilize the dollar. We can't keep going down, but we're going to get the Federal Reserve, the Bank of Japan, and then the German Bundesbank to coordinate interest rate policies so that we don't have a currency crisis. But then in the fall of 1987, there was a dispute.
Market crash, October, right.
That was. And that was caused by a dispute between the United States and Germany and Japan. And then James Baker, our Treasury Secretary, says the deal's off. And one day when I came in, I was shocked. The dollar was in free fall. Treasury bond yields went up over half a percentage point in the morning to over 10%. And the stock market then sold off 22%. So that is the example of a crisis in confidence where people say, oh my God, I don't know what to do. And what I'm basically saying is afterwards, we patched up that. Everybody said, I'm sorry, we didn't mean to fight. And they were actually able to stabilize the situation. So what I'm saying is it's too early to say that we're headed there. But I'm starting to watch very closely if bond yields keep rising and the dollar keeps going down, it's a clear signal that international investors say, you know, I used to trust the US. I'm not sure I trust their policies anymore. So they simply don't have confidence.
So it's an unusual circumstance when the dollar depreciates and interest rates on treasuries are rising.
So that's what I call the crisis zone. You don't want to be in the crisis zone, and I don't think we're there yet. If that were to happen, that's when you get major sell-offs, in the currency market, in the bond market, and in the stock market. So that's what we want to make sure does not happen.
And I might add that in our current circumstance, where the U.S. has more outstanding debt than ever in its history, and 40% of treasuries of our government debt is held by foreign investors, by foreign governments.
Largely foreign governments, correct.
Right, China, Japan.
Yep, Japan.
But China is a big holder of U.S. treasuries as well. That puts us in an even more precarious situation because we are dependent upon them to finance our debt.
The difference that I feel today, you can't ignore that possibility, is we're basically in a trade war. And that's how you get into a tit for tat.
Right, and a crisis, potential crisis.
And in that world, everybody loses. And you asked, why is it a global shock? Because the whole world economy will be weakened if we get into this full-blown trade war. And that's why world markets it's not just the US market selling off, world equity markets are selling off.
The subtitle of Global Shocks is an investment guide for turbulent markets. All right, so put on your investment strategist hat, which you were for many years. What do we do? What's your advice? What are you doing with your retirement portfolio that you oversee?
In my personal retirement portfolio, I want to explain. I actually reduced my allocation of U.S. equities in February, as much as I've ever done. And it reflected, though, two things. One was that I really thought that the policies we're doing, even though they may have had good intention, I think they were very poorly designed and executed. And I was fearful of a loss of confidence that's ensued. So I'm doing that to protect myself reasonably. But the other thing is, as people have probably guessed, I've been around for quite a while. And I said, at this age, this advanced age, in the past I would say when I was younger, you know what, the markets sell off, but they always come back, I'll ride it out. Unfortunately, the actuarials suggest that I don't know if I have enough time to ride out. So a second consideration for somebody my age is that even if the market comes back, it may take longer than we thought. And it doesn't just have to mean that you're going to, let's say a poor person on retirement income. What if they get wiped out and, they don't have time for the market to come back? What somebody my age might do could be very different from the strategy for somebody much younger.
And talk about somebody much younger.
I'm now saying to younger people, guess what now? I think that there's now more a case for thinking about diversifying internationally. Two reasons. Reason number one, because the international markets lagged for so long, they're just not as expensive. Think of it in terms of their PE multiples versus ours. They're significantly cheaper. So you've got a value argument. But see, I think that the difference is, again, I'm trying to look for silver linings.
Right.
I think Trump is correct that Europe, on the security, just took advantage of the United States. They didn't pay for their fair share. So one of his goals is to spread the burden. And the Europeans were doing so, but very gradually.
Right.
So the one thing that this, coupled with how committed is the U.S. to NATO, all of a sudden Europeans realize we have to pick up and pay for our programs. And then now Germany has a new chancellor that is finally taking bold action to increase investment in the country. So I would say that it's too early, but I have more reason to be hopeful now that Europe might get its act together, whereas before I said they'll never get their act together. So that's the other consideration.
Nick, one investment for a long-term diversified portfolio, what should we all own some of?
I would increase my allocation to international equities with a focus right now on Europe, where the premise is that the Europeans realize they've got to get their act together. So I'm hopeful that therefore their returns on their equities will be higher than, they won't be lagging the US. And then the second consideration is that if you have trade barriers and you don't have as much globalization, the correlation of the foreign markets and the US market on the equities, that goes down. And what that means is that you get added benefits of being diversified. So that's the case for considering the international markets.
All right, Nick Sargent, author of Global Shocks. Thank you so much for joining us to put the events of recent weeks in perspective. Thanks, Nick.
Thank you, Consuelo.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is Read Against the Gods, the remarkable story of risk. This investment classic by the late financial journalist and historian Peter Bernstein takes us through the evolution of man's understanding of risk, from the ancients' belief that our fate is determined by the whims of gods, to our current beliefs that we are independent agents who can manage risk and direct our own destiny. It is a wild and fascinating history with many colorful characters and events along the way. As a very favorable book review from the Federal Reserve Bank of Boston put it, Bernstein believes that we are rational as far as it goes. To know what he means, read the book. That would be rational. I could not agree more. As the markets teach us every day, managing risk is a never-ending challenge. Well, next week, global financial thought leader John Lipsky explains what the shakeup in U.S. trade policy means for the world's financial system. Please follow us on Facebook, X, and our YouTube channel. Thank you for watching. Have a great weekend and make the week ahead a healthy, profitable, and productive one.